There's a lot of indicators out there. We're going to cover some of the basic things on the indicators for the stock and bond market. What's out there, all the different aspects of it. There's so much intriguing aspects to the market, and it just can sit down and consume time. It's an enjoyable hobby. It's also an enjoyable profession if you choose to do it, except you may end up getting ulcers after a while. Okay, the most standard one you hear a lot about is the Dow Jones Industrial Average. We call it the Dow, okay, out of affection and love. Oh, okay. It really deals with 30 companies. That really is a teeny tiny sample of the industries as to what they're out there. And they actually have 30 companies. They're pretty standard from year to year as to which companies they are. They do change occasionally, but for the most part, they try to use it as a measure as to the productivity of manufacturing in the United States. A lot of people think it's such a narrow thing. I do too, by the way. Probably the better one is the S&P 500, Standard & Poor's 500 stocks. They track a combination of 400 industrial, 40 financial, 40 public utility, and 20 transportation stocks. And it really is more a better picture because it's so big. It's called diverse. It's much more diverse of what this bond and stock market is because of the fact that you're out there, you're seeing the volatility of the market going up and down. And really, if you buy a mutual fund that really is based upon the S&P 500, actually everybody that's done that has done relatively well in the market. Here is the Dow. The original Dow had 12. Now there's 30. These are the ones that are in there as a whole. You'll see some of them you don't really think of as a manufacturing company, okay, in the process out there. But you see now they could be. Even McDonald's is in there. So if McDonald's can make it, anybody can make it. Procter & Gamble and everything else. You have all these things out there, and that's pretty common. Here are a couple things. The market has a roller coaster. It goes up and it goes down. And it goes up, and you'll see in one day, okay, when you start talking about an entire market losing 13% of its value way back when, you'll see all kinds of volatility. You'll see volatility even in today's market. Everything could be going really fine. An announcement comes out, the Federal Reserve, we're going to be raising interest rates because of inflation. Everybody runs, the market plunges. People sit down and expect that, and they're short selling the process as you go through because of the fact that they have the market going down, and people are betting it's going to go down. They call it short sellers in the process. So riding the roller coaster, you'll see there's been all kinds of different things. Exoduses from the stock market into bonds. Okay, stock down, bonds up. Also stock down. Precious metal investment tends to go up as well when the economy goes into crisis. Okay, so you'll see that as well. It's huge. It's dangerous as you go through. You have a lot of different activities out there, and you talk about the different things. If you sit down there and get stuck by program trading, keep in mind, if you're going to invest in stock and bonds on your own and not take advantage of ETFs or mutual funds, okay, you're going to go up against a computer. The computer may have 13 set points. When this stock does this, when this bond does this, and all of a sudden, boom, that computer sells everything in a matter of 15 seconds. And all of a sudden, they sell $70 million worth of stocks and bonds. That's going to have an impact. And it could have a favorable one to you, but usually that may have an unfavorable one if you happen to be caught up in the same mix of stocks and bonds that computer decided to sell. Program trading can damage you and destroy you in just a minute because you're going up against a machine, and also a machine that controls a massive amount of funds, capital in the stock and bond market. So be cautious as you go through. Program trading can do that to you each and every single time. So be cautious about it because stocks can dip, stocks can increase. It all depends what's going on there. You also have market bubbles, like the technology stocks up, 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 and all of a sudden, in a matter of 5 days, you have a giant crash. It could be technology, it could be cars, it could be batteries. All of a sudden, you can't get chips for cars. All of a sudden, you can't get lithium for batteries. All of a sudden, rare earth for batteries is all dried up. All of a sudden, wind power on the East Coast, the people in Massachusetts, we're sick and tired of looking at windmills. No more windmills. The stock goes down. Stocks go up. Stocks goes down. Sometimes it's because somebody said, did you hear? And all of a sudden, goes across the whole country in a matter of seconds on Twitter, and everybody panics and they all sell or they all buy. So there's market bubbles. In other words, the market skyrockets and it goes down just really fast in the process. The bubble bursts, and all of a sudden the stock that people were buying at the very top of the bubble, all of a sudden now they're at the bottom of the bubble in a matter of seconds, days, or weeks. So we call those market bubbles. So in the process, as you go through the indicators, watch them. The Dow Jones Industrial Average has been around a long time. People trust it. Probably a better measure is the S&P 500, Standards & Poor's 500, 500 different stocks they track. Watch out for program trading. Sometimes it's exciting to try to beat the computers, okay? And then also pay attention to what we call market bubbles. With that, if you go into this market, take care, be cautious, go with your eyes wide open, and pay attention on a daily basis. Take care.